Right, today we are going to be looking at the first concept in Matric that always causes lots of headaches, and that is the macroeconomic multiplier. Right, the first step, we look at the definition and what this means. Initial government spending causes a ripple effect on the entire economy and leads to more total spending. What this means is that the initial spending becomes someone's income. That person would then spend some of that and save some. Then the spent portion becomes a second person's income. And that person once again will spend some and save some, and so it goes on. And this is known as the multiplier effect. So it is an original spending from one person that is being multiplied. In this case, we saw that there was an initial spending and then two other people also spent from that initial spending. So what am I saying here? To break it down for you, let's say I have 100 Rand and I spend my 100 Rand with person A. So now person A has earned 100 Rand. Person A then spends 80 Rand with person B and saves 20 Rand. Person B has now earned 80 Rand and he spends 60 Rand of his 80 Rand with person C. So if you look at it, originally there was 100 Rand spent, but out of that 100, we get a total spending of 100 from person A, plus the 80 Rand spent by person B, which is now 180 Rand, plus the 60 Rand spent by person C, which is now 240 Rand. So you get a total spending of 240 Rand out of the original spending of only 100 Rand. Right. The size of the ripple effect depends on whether people save or spend. This is known as marginal propensity to save, which we abbreviate as MPS, and the marginal propensity to consume, which abbreviates to MPC. Please note small letters MPC because, as you know, we also have capital letters MPC, which stands for Monetary Policy Committee. But here we're talking about marginal propensity to consume. So, for example, if you picked up 100 Rand and spent 75 Rand and decide to save 25 Rand, then your MPC is equal to 0.75 or 75%, and your MPS equals 0.25, otherwise known as 25%. Therefore, MPC plus MPS is equal to 1, which is a whole. So, there are only two things one can do with the new income, and that is you either spend it or you save it. Right, how do we calculate? So the equation for the simple multiplier is as follows. The multiplier is represented by the letter K because we can't use M. M is for imports. So we say K is equal to 1 over MPC. Sorry, 1 over MPC, 1 minus MPC, okay? And therefore, if MPC, let me just take that out there, oh sorry, right, so 1 over 1 minus MPC, therefore if MPC is 0.5, then MPS is also equal to 0.5. Therefore, you're then sitting with 1 over 1 minus MPC, which will be 1 over 0.5, which will then give you an answer of 2. So if the government, so if we look at example 1 now, if the government spends 2 million, the total spending will become 4 million because we take the original spending of 2 million and we multiply that by the size of the multiplier, which is 2. So a spending of 2 million times 2 will then eventually become 4 million. So let's assume the MPC is 0.9 and the government wants this total spending to increase by 20 million. You need to ask yourself two questions. How much is the multiplier, or what is the size of the multiplier, and how much must government initially spend to reach the goal? So let's see. So let's first of all, we're going to calculate the size of the multiplier. So 1k is equal to 1 over 1 minus MPC. And we were told that the MPC is 0.9, so therefore that is equal to 1 over 1 minus 0.9, which gives you an answer of 1 divided by 0.1. So therefore the value of the multiplier is equal to 10. So in order to achieve the goal of 20 million rand spending, government will have to spend 20 million rand divided by 10, which is equal to 2 million. If you remember in example 1, we just go back quickly. In example 1, we said it was 2 multiplied by 2, which gave us the 4 million. But in example 2, what we have is we know that they want the 20 million, and we know the value, the size of the multiplier is 10, so we want to know what must eventually be spent. So now you're working backwards. So instead of multiplying, we now divide. So basically, all we're doing is manipulating the formula, because to get to your 20 million, it is your initial spending multiplied by the size of the multiplier. Right, we note that in both examples, the initial spending was 2 million rand, but the total spending differs, right? This is because the MPC differed. In example 1, the MPC was equal to 0.5, which resulted in a total spending of 4 million. Whereas in example 2, the MPC is equal to 0.9, which resulted in a total spending of 20 million. Therefore, we can conclude that the higher the MPC, the higher the multiplier. And this is a very, this is a question that is often asked: what is the relationship between the MPC and the multiplier? And there we've just shown you now that relationship. The higher the MPC, the higher the multiplier, which means the opposite is also true. The lower the MPC, the lower the multiplier would be then. Right, I hope you've all grasped that so far. Right, we're looking at, first of all, the equilibrium in a two-sector model. Now, when we speak about a two-sector model, we make the following assumption. We say that there is no government present, there is only households and businesses, so therefore, because they're not interacting with anybody outside, they are known as a closed economy, as well as no corporate savings. So according to John Maynard Keynes, equilibrium exists when aggregate demand is equal to aggregate supply. Keynes also assumes that all income is spent, and therefore income and expenditure are directly proportional. So remember, we're talking about a two-sector model with only households and businesses. Right, so if you have a look at the graph, what we do to determine our national income. So you see there's a 45-degree line. You see this line here is called your 45-degree line. And another term that we use for this line is also known as the line of equilibrium, right? Because what it means is that anywhere along this 45-degree line, the economy will be in equilibrium. and that also represents your supply, right? So your supply is your C plus your S, right? And please remember, C is consumption and S is savings. Then you also have your demand curve, right? And your demand is, once again, your consumption plus investment. So what did we say? Where your aggregate supply meets your aggregate demand, that would be your point of equilibrium. So there you have your consumption and there you have your investment, right? So what we have here is, at the point of equilibrium, what do we see? Our income, which is at the bottom here, and income, remember, is represented by the letter Y, is equal to 200 billion. And your expenditure is also 200 billion, right? The other thing I want you to notice is you will see that your expenditure never starts at zero, right? And the reason we have that situation, that expenditure never starts at zero, is as a result of a concept known as autonomous consumption. Now, what do we mean by the word autonomous consumption? So if you listen to the word autonomous, means that there are expenses that we have to take care of. Nobody can go around saying, I have absolutely no expenses, right? There is something you're going to have to spend money on. So therefore, your expenditure will never be at zero. Right, let's look at activity 1. And the question says, use the information given in the graph to calculate the initial injection. And number 2, it asks you to calculate the MPC. So if we go back to the graph, they want you to say, what is the initial injection? What is the initial amount that has been spent within the economy? So we see C, which is for the households, spent 50. I, which is for the businesses, also spent 50. So if they spent 50, plus the 50 that they spent gives you 100. So your original investment was 100, right? That is what was originally invested. And we know that at the point of equilibrium, which shows after that 100 Rand was invested, there was 200 billion Rand that was spent in total. Now the second question says, calculate the MPC, right? So we don't know what the MPC is, but we do know that the value of the multiplier is 2. How do we know that? Because our income is 200 and our expenditure was only 100. So if I take my 200, which represents my income, divided by expenditure of 100, so the value of my multiplier is 2. And we know that the formula for calculating the multiplier is 1 over 1 minus MPC. So therefore, 2 is equal to 1 over 1 minus MPC. So therefore, MPC is equal to 0.5. Okay? For those of you maths people, you know what we are doing is you are taking the 1 from this side and you're taking it over to that side, right? So that 1 becomes 1 over 2, and 1 over 2 is equal to 0.5, right? So 0.5 is equal to 1, is equal to your MPC. Right, so we've just finished with a 2-sector economy. We're now looking at a 3-sector economy. Now, with your 3-sector economy, you've now got an added sector. Remember, with 2-sector, we had only households and businesses. Now, with the 3-sector, we've now included the government as well. Now, once again, we've got only households, businesses, and government. They are not interacting with the outside world, so therefore we're once again looking at a closed economy. Right, so with the introduction of government, two variables appear, and these two variables are government expenditure and taxation. Now here we come across two concepts that we were taught when you were introduced to the circular flow, and these are injections and leakages. Injection is denoted by the letter J. Leakages, on the other hand, is denoted by the letter L. Now, if you recall, the government earns their income from the taxes that they collect from people, right? And so therefore, when it's in the hand of the consumer or the businesses who are taxed on their income or taxed on their purchases, that then becomes a leakage. But when it's in the hands of the government, it becomes an injection, because it is this tax money that government has earned which they can use to spend on the goods and services which they supply. And therefore, that then is an injection. So on the one hand, if you remember the definition for a leakage is when money leaves the flow, whereas an injection is when money enters the flow, right? So please bear in mind there are various taxes that people have to pay. It's not only income tax. Income tax and company tax are examples of direct tax, but we also have indirect taxes. Right, and we assume that your government expenditure is equal to your government revenue, represented by the letter T, and government expenditure, as you already know, is represented by the letter G. Right. So, how is income determined in a four-sector economy? Now, when we speak about a four-sector model, this now refers to an open economy. Remember, the two-sector and three-sector both refer to a closed economy. Now, within a four-sector economy, the role players are households, businesses, government, and the foreign sector. Now, remember, when we introduced the government, the two variables that we introduced there was injections and leakages. Now, with the foreign sector, we have another two variables that are introduced, and these are imports and exports. So, imports, that is when we are buying goods from outside, meaning we have to pay to receive those goods and services. So once again, we are having to pay, so that means there is money that is leaving the flow, right? So therefore, as taxation in a three-sector model was a leakage, the same then in a four-sector model, imports is also seen as a leakage, because imports causes us to spend money. Now, just want to stop there for a moment, because this is something that confuses learners, and it even confuses them when you introduce the circular flow in grade 10, that how is it you are importing but it's a leakage? Because surely imports are goods coming into the country. Remember, we are looking at the flow of money. So yes, we are receiving the goods, but we are having to spend money in order to get those goods. The second variable that we have are exports, where exports, on the other hand, these are South African goods and services that are sold to the outsiders, right? So we sell them our goods and services, and for that we receive money. So therefore exports are seen as an injection, the same way in which we look at government expenditure in a three-sector economy. Right. The effects of exports and imports. Okay, so the symbols that we use to denote our exports and imports, X for exports and M for imports. Remember I said to you we can't use for our, to determine the value of the multiplier, it was K is equal to 1 over 1 minus MPC. We couldn't use the letter M because M is for imports. Right. So what will the effect be? If our exports are greater than our imports, so then therefore national income will increase. But if our exports is less than our imports, then that means our national income will decrease. Right. We're looking at the equilibrium level of income. So we're looking at the equilibrium position of an open economy. So when we speak about an open economy, it's also known as a four-sector economy. So equilibrium will exist when your national income is equal to the national expenditure. So your income will consist of your consumption plus savings plus taxes, right? And these all together will be your gross national income, and they are exactly the same as your aggregate supply. Where your expenditure, on the other hand, that will consist of your consumer spending plus investment spending plus your government spending plus exports minus imports. So if you remember, that is the same formula you were taught as your GDP formula in grade 10, right? So those together will then give you your gross national expenditure, and that will represent your aggregate demand. And as we said, where your aggregate supply equals aggregate demand, that is where we will find the point of equilibrium. So, right, let's just have a look at our graphical representation for a four-sector model now. So here we see the four-sector model. There you have your Usama, the y-axis just disappeared from here, right? But obviously there'll be a line going down there as well. So you have your line of equilibrium there, right? And there you have your C plus I plus G, which represents your three-sector model. Your C plus I represents your two-sector model. And then there we have our four-sector model represented. You see that? So there's our three-sector, four-sector, and our two-sector. Okay? And what we note here is that there at point D is where your four-sector and your three-sector meet, and here at point E is the equilibrium point for our four-sector model, right? Because that is now where your expenditure crosses your income. Okay? So there you've got all three on one set of axes. So now we've looked at the two-sector, three-sector, as well as the effects of a four-sector model. So just to sum up very quickly what we've done till now is that you have a two-sector model, a three-sector model, and a four-sector model. So if you look at your two-sector model, we said within our two-sector model, that consisted of households, which is denoted by the letter C, plus your businesses, which is denoted by a letter I. Your three-sector model, on the other hand, this is households plus business, and then we added the government. And the four-sector model is where we've got the three-sector, and we've just added now our exports as well as our imports. Okay? And the important thing to remember here is that when our exports are greater than our imports, then the national income increases. But when our exports is less than our imports, then the national income will decrease, right? And this is the effect that we are looking at when we talk about a four-sector model, right? How it is going to eventually affect the national income of the economy. Now, fortunately for you, you will never be asked to draw the four-sector model. However, you will be asked or can be asked to do the two-sector model. And that is what I would like us to have a look at now. So we are going to assume that the MPC is equal to 0.6, right? We're going to assume our MPC is 0.6, and we are working with a two-sector model. So we've got our households and we've got our businesses, right? So let's say, for example, so if your MPC is 0.6, that means that your consumers are spending 0.6 of their total income. And let's say your businesses, on the other hand, have invested 20 million rand. Okay? So now the question is, what is the value of the total income in the economy using this information here? So the first thing we're going to do is, we're first going to find out what is the value of MPC by using our formula. K is equal to 1 over 1 minus MPC, right? And our MPC is 0.6, so that means that's equal to 1 over 0.4, and 1 over 0.4 is going to give you an answer of 2.5. So now I know the value of my multiplier is 2.5, so I'm going to take that 2.5 times, let's just put the rand million there, times the 20 million rand that the businesses have invested. So the eventual income is going to be 2.5 times 20, which is going to give you 2 is 40 and half of 20 is 10. So that's going to give you an eventual income of 50 million rand. Now the question is, you've done the calculation. You need to plot this on a two-sector model graph. Now, if you look here on this graph, there you have your two-sector model there, right? The C plus I. Okay? So, let's see how we will draw this then. So, we've got, and remember, we always draw, we can do our lines in pencil, but our labels have to be in pen. Now you see there I'm starting to write quantity. It is income, which is denoted by the letter Y, and this one here will be expenditure, which is now the letter E. I then draw my 45-degree line, And this is the line where y is equal to E. Now, some students think that's it. I'm done. I must now just draw my equilibrium. No. You still have to first put in your consumption function line. Remember, this is 0. Our expenditure, as I said, can never be 0. So our expenditure starts, let's say, somewhere here. And they invested 20 million. Okay. So my consumption function is 20 plus 0.6y. And where it intersects, that is my point of equilibrium. And at that point now, my total income will be the 50 million. Okay, so with a spending of 20 million and consumers spending 60% of their income, it will give us an eventual national income of 50 million. So now let's say, for example, the business decides, oh, we want to invest an extra 10,000, okay? So which means their 20 million is now going to become an investment of 30 million. So now we need to show it on the same graph. So we take it one step further. And there we go. Now we have our 30 million. So now my consumption function also changes. So that will now be not 20 anymore. It will now be 30 plus 0.6y. And there where it crosses what I said, also known as the line of equilibrium, what is my eventual income now? It is now still 2.5 because that hasn't changed, but this has changed. So instead of 2.5 times 20, we're now going to have 2.5 times 30, which will then give you an eventual income of 75 million. Right, so all the different ways in which this can be tested, various ways that they can test you. They don't have to give you your MPC. They can leave that out completely and just give you a graph with just the figures on it. Okay, so I just want us to have a look at that. And so I'm just going to redraw that very quickly. And my 45-degree line of equilibrium, that is where y equals E. And we had 20 million with an income of 50 million. So that's all the information you are given, nothing else. Now the question says, calculate the value of the multiplier. Now you know the formula is K equals 1 over 1 minus MPC. So we know what K is because that's our eventual. Sorry, we don't know what K is. Right, we need to calculate K, but we know we take K times the spending to give us our income. Okay, and we know that the income is 50, and we know that the spending, which we find there, is 20. We don't know what K is. So can we now go find it? Yes, because I take X is equal now. I'm multiplying here, I'm taking to the other side, so I'm going to divide. So that gives me an answer of 2.5. So now I've got my value for K. So once again, we use substitution. So I say 2.5, which is my K, equals 1 over 1 minus MPC. Right? And now I'm going to calculate what my MPC is again. Right? So now my MPC will be 1 over 2.5, which is going to give you 0, that's going to be your MPS. Is going to be 0,4, right? Because 1 minus MPC is your MPS, right? So 0.4, so remember what we said, 1 is equal to MPC plus MPS. So if MPS is 0.4, then we don't know what that is. So therefore, it's 1 minus 0.4, which will give you X, which will then be 0.6. So all you need to know is to know the formula for calculating the value of the multiplier and then being able to manipulate that multiplier. Now, many times in an exam, they will, for an 8 marker, they will ask you, this is the amount that has been originally invested, this is the MPC, calculate the value of the national income, and then you have to plot it on a graph. Alternatively, you can be given a graph such as this one, and they will say to you, now draw in the new consumption function. So we can now fill in this consumption function, which will be 20 plus 0,6y. Now they say to you, draw the new consumption function if the business increases its spending to 30 million rand. Now, there you must be careful. The question says it increases it to, not by. Okay? So if it's to 30 million, it means originally they were at 20 million, and now they are moving that 20 million to a 30 million investment. If it said by 30 million, then that 30 would be a 50 million investment. Okay, so which means your new consumption function is C is equal to 30 plus 0,6y, and as we worked it out earlier on, that 30 will then become a 75 million. What you need to bear in mind, people, is that the way in which you calculate it, that doesn't change. The only thing that's going to change are the numbers, right? They can only change the investment that was made, the increase of the investment, and the other thing that will obviously change is the MPC. And if they don't give you your MPC, they just give you this consumption function, then you know the 0.6y. That 0.6 is your consumption function, because what this is telling you is that businesses invest 30 million and consumers invest 60% of their income. And that is all you need to know with regards to the two-sector model. Now, please remember, this is a section that hasn't really been tested much in the past, but every year I tell my students, this is probably the year they're going to be testing it. And the four-sector model, or the effects of the four-sector model, is the section that they have, that they now looking at presenting, right? They're looking at what are the effects of the four-sector model. I can't get back to that slide that shows you the effects of the four-sector model, but do you get the understanding? So when we look at the effects of the four-sector model, we are looking at how exports and our imports affect our national income, right? So we need to be sure that when our exports are greater than our imports, national income increases, but when our exports are less than our imports, then the national income will decrease. Matriculants, that is all there is with regards to the multiplier. I hope you have been able to consolidate, especially the work taught with regards to the two-sector model, and that you have a better understanding of those graphs and how to plot those graphs, or an understanding on how to read and make sense of the graphs. I would also like to encourage you to please make use of the WhatsApp line to ask questions and to interact with us, okay? Because that just adds to the discussion and will just makes it more interesting. Okay, that's all from me today. Thank you very much.